It is looking comfortable for the global markets. Let me welcome on board Matt Orton as well and ask him about what he's making of the market mood right now. Matt, hi, morning. Great to have you on the show once again. Matt, clearly it's the fundamental strength of at least the U.S. equity markets, which one can't underestimate, irrespective of all the chatter and the news flow around West Asia. You've still got the S&P and even the Nasdaq eking out fresh highs pretty much consistently.
Hey, good morning, Asia. And that's exactly right. The U.S. market has been underpinned by really strong fundamentals, and that comes from earnings growth. The S&P 500 is running at over 50% EPS growth year over year, which is just an absolutely crazy number. But I think what's most important to point out for investors is that the strength in the U.S. market isn't just concentrated in technology or communication services or the semiconductor trade anymore. It's really been broad. You've seen strength across financials, you've seen strength across industrials and more cyclical type industrials, real estate, materials. All parts of the economy are working well, and I think that's why the US market has been able to shake off a weaker July. You saw the broader market still hold up nonetheless, and we're continuing to push to new all-time highs. And I encourage investors to use dips opportunistically to continue to get exposures right in their portfolios.
What do you have to say about the soft payroll data that came in on Friday? Is that a good sign for the market, given the market was expecting a rate hike, but now it could be a pause? Or are you going to wait for the CPI numbers, which are going to come on Wednesday?
I think really all it does is push the focus to Wednesday for the CPI data. I wouldn't read too much into the payrolls data as being weak. I think it simply confirms that the US is in this low hire, low fire environment, and that it's the lower labor force participation rates more due to immigration policy than anything else. So I would actually argue that the labor market itself is healthy. Smaller businesses do continue to hire. It's just reflecting the fact that not a lot of workers are either, that there aren't a ton of job openings, but we're also not firing people as well. So I think that is an encouraging signal to take, but it's all going to come down to Wednesday. And I think if Wednesday's data is soft, if the CPI and inflation data comes in weaker than expected, I think that all but confirms that the Fed's going to remain on hold. Granted, there is still one more piece of inflationary data we're going to get before the September meeting.
I'm just trying to get a sense as to how you're reading into some of the commentary coming in. For example, Lisa Cook, she's of the view that inflation is going to be sticky and therefore rate hikes could well be on the anvil. But the rate hike expectations, at least for September, have come off to now 47% from above 60%, just given the non-farm payroll data which came out. How are you reading into some of the macros which have come out at us over the last 3 to 4 days from a U.S. policy standpoint?
So I think U.S. policy is actually well calibrated. I was quite surprised by the pushback the market had to the Warsh's FOMC meeting, because when you actually look at the data, there's nothing I see in the data that says the Fed imminently has to hike rates. The most recent CPI data we got was softer than expected. While there might be some sticky components to inflation, when I look at the bigger drivers of that, be it shelter, be it wages, we just saw from the most recent jobs report on Friday, wage growth doesn't seem to be a significant issue, and that's been consistent for the past few months in a row. Housing data continues to come in fairly soft. We're not seeing a ton of inflation coming through from that sector either. So to me, I think policy is fairly well calibrated. And as long as we don't see bond vigilantes return to the market trying to force the Fed's hand, I think that bodes well to interest rates maybe being capped at the short, capped for right now, at least in the shorter term, until we get a little bit more data. And I think that's constructive for global markets as well. We've seen the US dollar sell off a little bit. That's been beneficial to gold. That's been beneficial to international markets. These are all places where I think investors can and should be looking for diversification opportunities in portfolios.
Matt, last off, what do you make of the US 10-year bond yield then? I'm very curious to know, because if rate hikes were were not realistic. The US 10-year bond yield moving to 4.67% now. I wonder what you make of that.
It's getting attractive. I
Yes.
spent the past couple of weeks meeting with investors, and it really stands out to me that a lot of investors are finally excited about the yields. For investors who need income for portfolios, they are buyers at these levels. I am not willing to add too much duration into portfolios just because there's still a lot of data to come. But if the 10-year yield in the US were to approach 5% for whatever reason, I would start to look to aggressively add duration into portfolios, because I think at that point, bonds would be undervalued fairly significantly. And I think that would spell a good opportunity to perhaps get fixed income at very attractive long-term yields into portfolios.
Right, Matt, so good chatting with you. Thank you so much for your time.
Thank you.